Well, welcome everybody, and thank you for joining us today and taking some time out to hear the RSM 2023 Budget Webinar. My name is Andrew Sykes. I'm a Director in the Business Advisory Unit of RSM, and I'll be your host for today. I'm going to be joined by a panel a bit later on, but I'll introduce them as we go through. So it's been a big season of in politics, and if it's a sport, the siren has sounded and the budget is out. But a bit like the grand finals this year, it wasn't the spectacle we hoped for. However, there are always changes in any budget, and it's really important to understand how they affect you personally and affect your business. So we're going to run through in a bit of detail on how we scored the budget. We had our RSM team up overnight and they've scored various measures in the budget. We'll run through those in detail. Now, you can get our more detailed report, which has a full budget analysis. You can get that at rsm.com.au. That's a free report you can download with our full analysis of every budget measure. So, how did we like the budget? Amid some significant headwinds economically from around the world, and domestically and abroad, there was a consistent rhetoric in the lead up from Treasurer Jim Chalmers about this budget, this mini budget, and it was going to focus heavily on counteracting those perceived headwinds, dealing and assisting the independent RBA in their job, and very importantly, on the perceived tax avoidance by multinationals. That's a real theme throughout this budget. The centrepiece of the mini budget, though, from a spending perspective, was Treasurer Chalmers' 5-point plan for cost of living relief, something that's really important for all of us. Number one was the $4.7 billion to deliver cheaper childcare. Two, we saw $532 million to expand paid parental leave. We saw a new national housing accord, which was going to deliver 20,000 new affordable homes. And we also saw $780 million set aside to reduce the co-payment under PBS from $42.50 to $30 per script. And we saw some very real measures on real wage growth and some real focus on that. In summary, it's a budget that delivers on the government's pre-election commitments from both payments and receipts perspective. This is a budget delivered into an economy that is continuing to grow, with Australia benefiting from stronger terms of trade in the middle of a commodities boom. So while there's a bit of caution in there and we saw our forecast growth rates declining, there certainly is little doom and gloom. Once again, Australia doing well because of our commodity resources. So we're going to have a look at the major highlights that has been put together overnight by the RSM tax team. And a big thanks once again to them. And as I said, you can get their report at rsm.com.au. We're going to run through some of those highlights now. So when we look at corporates, what were the changes? We saw some increased funding from the ATO to combat shadow economy activity and big business tax avoidance. What does that mean? We've got more staff going into the ATO. We have a stronger focus on compliance. There is significant funding going in there, and the government continuing to work on that tax gap, what they expect the tax to be and the leakage from avoidance. No changes to the depreciation rules. It's going to continue to be set by statute. And previously, there was an advantage for on-market share buybacks versus off-market share buybacks. They are now going to be treated the same. We'll go through that in a bit more detail with one of our experts. For individuals, there was a mixed bag of changes. There wasn't anything too big in there. So once again, the ATO is going to continue to be funded to look at individual tax compliance. So their tax compliance program for individuals has now been extended out to 2026, and we're going to see further activity from the ATO. There's been a lot of talk in the lead up to these this budget about the stage 3 tax cuts, and we saw no movement on that. So we are going to see those stage 3 tax cuts roll in. Unfortunately, we also didn't see an extension of the low and middle income tax offset. So that's going to impact negatively on those up to 126,000 in income. And we saw the thresholds increase for some help for the seniors, for the seniors health card. So the winners out of this area of the budget are going to be those earning more than $45,000, as they are the ones who are going to benefit from the stage 3 tax cuts. Internationally, as I said, there is a theme in this on international or multinational tax avoidance. So we're going to see the rewrite of the thin capitalisation regime, which is going to have big implications for those who debt fund businesses internationally into Australia. And there are going to be no royalty deductions for significant global entities and indirect, where there's direct or indirect recipient subject to a tax rate of less than 15%. So the losers are going to be the Australian companies in an asset-intensive industry. There will be winners in lower asset-intensive businesses such as technology, but overall we're going to see a big change, and we'll talk about that with our expert a bit later on. Superannuation, there wasn't a massive change to superannuation in this year's budget. So downsizes, so the reduction in eligibility age to make a downsizer contribution has gone from 60 to 55. So that's the ability to make a contribution when you sell your home and put some of those proceeds into super. There is a deferral of the implementation date for some proposed measures for the relaxation of residency requirements for self-managed super funds. And much to the relief of many trustees, the confirmed cancellation of the 3-year audit cycle for self-managed super funds. So the real winners in this is going to be the younger downsizers who may not have provided enough super, but will now have the ability to make a significant contribution on the sale of their home into their super fund. Once again, and we've seen this as a pattern in the last few years, there has been very little change in innovation. So there's no changes to the tax incentive program. There is a continued increase in funding across different sectors, but once again, we see a budget that's really lacking in any change in innovation and increasing Australia's competitiveness on innovation in the international landscape. So there are some losers in medical and biotech and agri industries who had previously hoped to access the patent box regime that had been implemented, but they are not going to get that. There is some help for older Australians in this and to the health industry in general, with the co-patient the payment for patients for PBS treatments reducing from $42.50 to $30 from 1 Jan 2023. We're going to see changes, and we've seen ongoing changes in the last few years around residential aged care, and they will all require a nurse on site from 1 July 2023. And there is increased funding for First Nations people, health and wellbeing, and the rollout of urgent care clinics. So the winners are going to be those patients, including those who are taking meds and aged care residents. So the government has made significant changes and proposals to address what is a big problem in Australia, is that housing affordability issue. So the Housing Accord, which will include industry, investors and the government, is aiming to build 20,000 affordable dwellings. There is also the establishment of the Housing Australia Future Fund, which will provide assistance in the construction of those new social housing dwellings. The government is extending a Help to Buy scheme to help home buyers with an equity contribution from the government and assistance for 10,000 eligible buyers out in the regions. So there's real winners in this, in affordable housing and Australian families and first home buyers. Manufacturing, once again, we don't see a real excitement or real change. We're seeing redirection of existing funds across from the Modern Manufacturing Initiative to the National Reconstruction Fund, and we're seeing funding to develop some domestic manufacturing capabilities and supporting defence and fuel manufacturing in particular. So we are going to see some improvement in Australian manufacturing and assistance from the government, and it is going to be in those companies that focus on those national priorities of defence and fuel. We'll now kick it off with our panel discussion, and I'll introduce to you my other panellists that I have with me here today. So with me, I've got Liam Telford, who is RSM's Australia National Tax Director and has extensive experience in all areas of tax and domestic international. Liam's experience includes roles within and outside of Australia with the ATO, the Big Four, and our resident mining giant, BHP. So welcome, Liam. We have also Grace Bacon. Grace is a partner in the RSM Financial Services Division and an expert on wealth and personal finances. So Grace is going to bring her experience to this and provide us with some insight on how the budget impacts on you personally. Rick Kimberley is a partner at RSM and leads the Australian Global Employer Services practice, specialising in both employment tax and expatriate tax matters. So Rick knows the ins and outs of the personal tax situation, and he's going to give some insight on how that's going to impact on all of us. So we've had some questions come through. I encourage you to do two things, which is download a free report at rsm.com.au, or if you would like to ask any questions while we're going through, put them in the chat there, and one of our panelists will answer the questions throughout the remainder of our session. We've had some questions that have come through previously, and Liam, I'll direct the first one to you. So the major impact of this budget seems to be the integrity in the tax system and reducing that tax gap, as I mentioned before. That's that expected tax that what the government expects versus what pays. Trusts are an obvious target in this. Where is Labor, based on this budget, likely to head re possible taxation changes with trusts?
Yeah, good question. I think the genesis of this question is probably some comments made by Treasurer Chalmers in late 2021 before the election, suggesting a potential revival of the short and narrow policy of taxing family trusts at a minimum of 30%. However, there was sort of a step back immediately prior to the election, whereby the ALP made clear that trusts weren't within the crosshairs, wouldn't be a focus of their election plan. Their focus would instead be on multinationals, as we saw last evening. In terms of future trajectory, I guess I would personally hope ALP learns lessons from 2019. And indeed, then Shadow Assistant Treasurer Stephen Jones made some comments to the effect that if it hasn't been announced, it's not Labor policy. However, it'll be interesting to see what happens once Labor's multinational agenda has actually been executed. This measure was forecast to yield or generate cash collections of approximately $2 billion per year. So, it's not insignificant. However, it's probably not the most populist measure. So I think it's a wait and see there.
Excellent. Thank you. Thank you for that. So there is a possibility we are going to see some real tax changes of trust, if not this year, over the term of this government. Is that a fair assessment?
I think that's absolutely fair. Anything's on the table, I think, in the current environment.
Yeah, and look, I certainly see this as a budget delivered by a first-term government just finding their feet. So I think as they ease into this, I think some of these policies that we've seen before put forward by the government may well come through. So cost of living is pretty significant, and Grace, we see that cost of living and inflation is a real part of this budget, and it's a major topic at the moment. Everybody's talking about it. Certainly impacting on older Australians, probably as hard as any group. What are some of the measures that you can see in the budget to address cost of living pressures for older Australians?
Thank you, Andrew. It certainly is a topic of conversation these days around the cost of living, and particularly for older Australians. There are two key measures that are being introduced to help older Australians to combat cost of living. The first one, as you already mentioned, is around there was a pre-election promise to reduce the downsizer contribution eligibility to age 55. And so it allows people, previously that was at age 60. This allows people to put to boost their super funds in addition to concessional and non-concessional contributions if they've sold a residential property that they held for more than 10 years. It just allows people to add additional funds into super in a more tax-effective environment to allow them to ensure that the capital lasts a little bit longer. Secondly, is the lifting of the income test threshold for the Commonwealth Healthcare Card. The income threshold will increase from about $61,000 to $90,000 for a single person, and from $98,000 to $144,000 for couples. This means more self-funded retirees will be able to qualify for this benefit, which will allow them access to healthcare and pharmaceutical benefits, discounts on utilities and transport as well. So this would certainly help older Australians to combat some of the cost of living pressures that they are facing.
Excellent. Certainly a group that needs to be looked after, particularly in our current inflationary environment. It was interesting to see the Treasurer forecast that inflation would continue through to the end of the year and then start to peak. So we are certainly getting very close to the end of this inflationary cycle over the next sort of 12 to 18 months. I think it was also interesting to see, talking about cost of living, that real wage growth is going to continue and will start to outstrip inflation. So some real hope there. But following on from those measures on superannuation you spoke about then, are there any other major super changes?
Not at this stage, Andrew. There's no major super announcements in this current budget, which is a relief to the industry. As I mentioned, the main change was the reduction in the downsizer contribution eligibility. However, some of the previous announcements that was made are worth noting. The deferral of the proposal to remove the central management and control tests for self-managed super funds and having that extend from 2 years to 5 years, and removing the active member test. That is still was meant to come into effect from the 1st of July this year, but it has not been legislated yet, and it will come into effect once it gets royal assent. So it is imminent that's coming, which is a positive for self-managed super funds and the trustees. And the other thing, as you already mentioned earlier, was around not proceeding with the 3-year audit cycle for self-managed super funds, which is a big relief for self-managed super fund members and trustees, given the ongoing administration and compliance requirements for self-managed super funds.
So super funds are going to get a little, self-managed super funds cheaper to run, more efficient. Just on the active member test, are you happy to run us through what that will entail? What do those changes mean?
So basically what that means, previously to be a member of a super fund, you had to meet the residency test for Australia. So you actually had to be, members had to be a tax resident of Australia, and you could only be absent from Australia for 2 years. Now that's looking to be extended to 5 years, which is a relief, particularly for potentially people that are working overseas or going overseas for a short period of time. They don't need to look at winding down their self-managed super fund.
Yeah, and that does impact on a lot of people. Australians love their travel, don't they?
And particularly now, borders opening back up, we've got expats moving overseas for short-term assignments, so they don't need to wind up their super funds.
Yep, excellent, excellent. So once again, to everyone listening to the webinar, just a reminder, we are more than happy to take any questions that you may have. If you would like to enter your question in the chat area, I'll direct it to one of our panelists and we can answer your specific questions on there, whether it's about anything you read in the budget or about anything one of the panelists says. So Rick, sticking to that personal impact, the stage 3 tax cuts, as I mentioned before, have been discussed a lot lately. I was certainly sort of kind of expectant that there may be some deferral or changes, but I'm not that good on my political read. What's, in your view, what's the future of those cuts?
Yeah, thanks, Andrew. And you're exactly right. The introduction of the stage 3 tax cuts has certainly had a lot of debate, given the current level of national debt, the challenging economic environment. And to be honest, I think the fact that higher income earners receive the greatest level of benefit from these tax cuts. I mean, when I look at the budget overall, I think this really was a budget for repairing public finances, helping with the cost of living and building that long-term productivity, and not necessarily drastic tax changes, particularly for higher income earners. So I think overall, if we're being honest, this measure probably does detract from that narrative a little bit. But as we stand, the measures will be introduced from 1 July next year, where we will see the 32.5% marginal tax rate cut to 30% and the 37% tax bracket scrapped altogether, with the big winners being any individual earning more than $45,000 a year. And so what does this actually mean? If we just think about a quick example, if you've got an individual earning $150,000 a year, they can expect to take home close to an additional $4,000 a year. So it's a pretty nice benefit for a number of people.
Yeah, that's excellent. So we've had a comment come through there on the Q&A from Peter Sackerson, who's indicated, and Grace, if you can confirm for pensioners that $6.80 treatment of the co-contribution.
Yes, certainly. So the comment from Peter is about that if consumers are not pensioners, there is a reduction in the pension co-payment for PBS medication from $42.50 to $30. Of course, for pensioners, that is going to be further reduced that's already reduced down to $6.80.
Yeah, excellent. So there's another question that's come through around NDIS and Labor's claims to be fully funding this platform. I think the only comment we can make on that is the unexpected rapid growth in the cost of funding. And I think I saw a figure there of something like 17%. It is strong. We can expect future measures, I would say, that will address the growth in that, either to be further funding or changes to the scheme to make sure it's sustainable. So, Liam, if we go back to you, so the budget is addressing, as we mentioned, the anti-avoidance of Australian tax by multinationals. That is once again something that has been in the news, and it's been a topic over a number of years. One of the ways that we're looking, or the government is looking to do that, is through reform of the thin capitalisation rules, or we're using debt with little or no equity, ensuring that the profits go in the form of interest overseas. What's your thought on the thin capitalisation measures that were announced?
Yeah, I guess the proposed changes, they're not inconsistent with the government's plan to ensure multinationals pay their fair share of tax, or the rhetoric that followed the election and preceded the budget. I guess the issue is that such measures sort of risk entrenching the growing perception that Australia's tax regime is punitive towards foreign investment. There'll obviously be clear losers, sort of taxpayers in highly leveraged asset-intensive sectors like infrastructure, property, and resources. But there are actually potential winners, such as, taxpayers who are heavily intellectual property based, don't recognise internally generated assets on their balance sheet. The main issues I have personally with this measure is the limited consultation. It took place only a few weeks prior to the budget, and it lasts only about a month, and it's got an implementation date of 1 July 2023. I'm not sure the impact on, model taxpayers. I don't think this is necessarily an egregious area. It's been fully considered, and indeed such haste seems almost reckless given the magnitude of the proposed changes. Also worth noting is that while these measures ostensibly seek to align Australia's rules with the OECD, safe harbour regimes like what's currently in place in Australia are typically seen in resource-rich jurisdictions like Canada, Chile, and until now, Australia. I think it could be argued that an asset-based regime alongside an earnings-based regime would have better reflected sort of the characteristics of Australia's modern economy.
Okay, so you're talking about that unfair impact because you need a whole lot of plant and equipment and versus something like a tech business where it's very limited assets.
Yeah, I mean, you borrow against your assets, right? And I think abroad, for example, in the UK, you see carve-outs for sort of, large-scale infrastructure projects and things like that, and those things just haven't been announced to date. So I think it's a bit of a wait and see. But at this stage, I personally do have some concerns, and I can see some taxpayers reacting pretty strongly to the announced measure.
Yeah, and I made the comment in my introduction that Australia is benefiting from better terms of trade. We're in the middle of a commodities boom. We're doing better than the rest of the world, but we're also net importers of foreign capital to run our businesses. Do you think there's a negative impact on us? Do these rules make it harder for us to chase that international capital?
Yeah, I think so. And just the general sort of targeting of multinationals generally and sort of painting them as tax avoiders, I think that that's only going to be construed negatively from foreign investors, by foreign investors, sorry.
Yeah, okay, that is a tough one. And I think the core, what I got out of your answer there is the rush nature that has been put together and the limited consultation with the professions and with industry.
Which is amplified by the magnitude of the changes. It's just incommensurate.
Yeah. So what do you see as other measures affecting multinationals?
Well, I guess the key one's probably the so-called low tax royalty integrity measure. Again, inconsistent with the sort of government's multinational plan, pre-election commitment. Actually, there were some welcome aspects of this in the budget vis-a-vis the consultation paper. So you see a tax rate of less than 15% being, the definition of low tax, as well as a requirement that a patent box regime must lack economic substance in order to be impugned. It's definitely less punitive than it could have been. The consultation paper was talking about low tax being defined as anything less than 24%, and targeting specific countries, which probably wouldn't have gone down too well with our key trade partners. But I guess my concerns are that it can lead to an effective tax rate in excess of 100%. You return the income, you're paying it across, you don't get deduction, you're paying tax in the other jurisdiction. That's not a good outcome. And it could lead to, as you sort of foreshadowed before, a negative perception amongst our key global trade partners. Interestingly, it stands in contrast to the two most recent budgets. They included proposals for Australia to enact its own forms of tax-preferred patent boxes. So think back to 6 months ago, it was a very different conversation that was being had. And I guess finally, to conclude on that, it's very unilateral. Obviously, we've got the BEPS initiative, and it's particularly unclear how to interact with BEPS Pillar 2. You've got the minimum global tax rate of 15%. So if you're looking at a minimum rate of 15% as sort of your threshold for application, or below 15% as sort of your application threshold, then sort of, you've got these measures that are going to be enacted, and we've got, more than 140 countries signing up to it. What's the point?
Yeah, okay, and look, that's just as a general comment, that's a shame to see, because that commodities boom that we're taking advantage of has been driven by international investment. So it'd be nice to see our government welcoming it and not being too punitive and painting model taxpayers in the same light as those that do engage in avoidance activities. Reminder, you can still send questions through. We've got a question here from Philip, who's asked, could you please explain if any changes to making large one-off payments into super, and he's apologised, we've already explained it, but if there are any changes to making large one-off payments into super. Grace, could you tackle that one for us?
No, there hasn't actually been any other changes to making one-off payments to super, other than the downsize contributions that's been now reduced to age 55 from previously age 60. We are expecting that indexation from the indexation will come in to increase the non-concessional contribution limits, but also the super transfer cap limits as well. So that's probably the only other incremental change that will come in, but nothing else has been announced so far.
Okay, so just to refresh me, how much can we actually put in on the downsizer contribution?
So the downsizer contribution, you can put in 300,000 per person. So per couple, for a couple, you can put up to 600,000 from a sale of a residential property that you've held for 10 years to put that into super. That is in addition to your non-concessional contributions and concessional contributions.
Okay, and so that's pretty good. So if you sell your family home that you've lived in for more than 10 years, you can put up to 600,000 into super, a more tax-effective environment for investment.
Correct, that's right.
Yeah, that's pretty good. Rick, going back to you, we saw reference to some concessions around electric vehicles. Have you got any views around those you can share with us?
Yeah, sure. There wasn't a lot in the employment tax space in this budget, but we did actually, yeah, we did see some commentary in relation to electric vehicles and fringe benefits tax. Essentially, the government was reiterating its commitment to helping Australians get access to zero or low emissions vehicles through the introduction of the electric car discount bill. But there is no change to the application of the bill itself. So, I mean, look, on the bill overall, I wouldn't say that the law itself is necessarily perfect. Both employers and employees will need to dot their I's and cross their T's to ensure they manage to receive the concessional FBT treatment that it's designed for. But I think it's certainly a step in the right direction. And given that we have known about this for a little while and known that this was coming, we've certainly had a number of calls from both employers and employees around the measure. So there's certainly plenty of interest around it at the moment.
Yeah, excellent. Thank you. And I did have one question come through from Reese. Was any update on the digital adoption by small business program? Is this moving or have they scrapped it? That's only, I'm not quite sure that's an issue we've addressed. If none of the panelists have got that, what I'll get you to do is to, or we can shoot an answer through you to you after the webinar. So if there's any questions we don't know, because the budget did come out last night and we spent the night working on it, and so some of us are probably a little bit tired, we'll shoot the answer back to you. But if anyone else has any questions, please type them in. And once again, I'll remind you that you can get more detail on our report at rsm.com.au. Liam, I mentioned before about the tax rules applicable to off-market share buybacks. Were you caught by surprise by this, and do you just want to run through what they were?
Yeah, I was definitely caught by surprise. I didn't see anything at all in the lead up to the budget. That might have just been me being a bit negligent, but I didn't see anything at all. The last time I heard of this being sort of an area of concern was several years ago, I think with a Telstra buyback. It's forecast to be pretty whopping to raise a pretty whopping $550 million over the 4 years from FY23, which if you sort of think about it, it's not particularly surprising given the level of off-market share buybacks we've seen recently by large listed companies. I think it probably sounds the death knell for off-market share buybacks, as it presumably removes the incentive for or willingness of any shareholders to sell shares at discount, as in you could previously opt in and get a rebate, on the franked dividend component to the extent your marginal rate was below 30%. And I guess if I were to be cynical, I'd draw parallels to previous measures aimed at the refundability of franking credits for certain shareholders, but let's not get into that.
Yeah, look, so that joins my my list of top picks for this term of government is that a further review of franking credit refunds, imputation credits, and trusts. So I think we are going to see a few changes and probably a little bit more excitement in next year's budget. So if we now go back to our cost of living, and I think this is another really topical area, and it's around the skills gap. I think one of the things that a lot of people see in Australia is that the shortage of labour, critical skills in this area. So Grace, I'll ask you about this one. What about any support measures to address critical skills and labour shortages via migration?
Thank you, Andrew. Certainly the budget's extended the announcements that was made in the Job Summit in early September, and the government has increased the permanent migration intake for this year, 2022-23, of 290,000 from 160,000. So that's an additional 30,000 visas that would be, I guess, issued to permanent migrants that are wanting to come to Australia. An additional $42.2 million of funding has been invested in accelerate visa applications, giving priority to offshore applications as well. This is a positive move because it will assist with the backlog of visa applications and accelerate the arrival of skilled migrants to Australia, which is a key critical issue right now. And the other point is they're extending the work restrictions that was lifted for international students during COVID. They're extending that till June 2023 to address critical skill and labor shortages. So international students normally are only able to work 20 hours a week. They now can work up to 40 hours a week. They're also extending that to secondary visa holders as well. So people that are here on secondary visas, they can also do this as well. And finally, the government has signed an agreement with the Pacific region under the Australian Pacific Labour Mobility Scheme to provide up to 3,000 visas a year, really helping our agricultural regions with seasonal workers. So there are some positive moves there to try and plug the gap in critical skills and labour shortages that we are experiencing now.
Okay, so it's some really positive news. In particular, I think that the ability for working more than 20 hours a week, up to 40, that's going to add massively to the labour market, we would have thought.
Yes, that's correct. Yeah.
Okay, so we've had another question come through in relation to R&D tax incentive. Liam, I'll direct this one to you, and they're asking, were there any changes to the R&D tax incentive?
No substantive changes, Andrew. There was some redirection to funding, etc., but no changes to sort of the R&D framework.
Okay. Encourage you, we still have some more time on our webinar. If there's any other questions, please enter them in the Q&A. We'll give a minute for that, and then we'll start wrapping up. So overall, let's say I think it was a reasonable budget. It certainly wasn't exciting. There is no massive change or policy shifts in it. And as I said in my introduction, is that what we are seeing is a budget where the government has delivered on its election promises. That's really where we saw those stage 3 tax cuts being safe, because the government went into the election promising to not change those, and they have not done that. So just a couple of questions that are coming through. Hi, Liam. So this one's to you, Liam. So we've got Jason asking, given there is no FBT on electric vehicles, how about the installation of home charger, so for faster charging, solely for the purpose of charging the electric vehicle?
Yeah, great question. I'll stand open to correction by Rick, who's our employment taxes expert, but the bill just refers specifically to the vehicle rather than sort of any ancillary, accessories or anything like that. So, hopefully there are amendments as it works its way through Parliament, but I'm not aware of anything that would support the FBT exemption of sort of, a home charger, for example.
Yeah, I'd add to that. I mean, it's a really good point you make, Liam. That is something that we're probably expecting going to be nearly a separate benefit. And so that's where I was saying that, earlier, that it's really important that employers and employees are going to dot their I's and cross their T's. There are a lot of things, obviously, you've got to ensure that the car is under the luxury car limit. You can't just give the employee a car. They can't just salary sacrifice the whole car. That would be a property benefit, not a car benefit. So there are lots of elements to this, and that's where I was saying that it's definitely a good step forward. But these sorts of things, such as charges and the like, and how they get provided and how you package them in, are things that aren't necessarily clear as to how that will work. I mean, what it seems to be at the moment is that depending on the value of it, there's every chance that could be a separate benefit and subject to FBT.
Yeah, or hopefully the government could look at the whole package and wrap in everything you need around an electric vehicle. We certainly think that there is going to be some strain on that as we go through. As we get more electric vehicles, there's going to be more wait time for rapid charges. So a question here that's come through from Marlene is, she's asked, do you think there will be any movement on the middle income tax offset? So I think, Rick, that's probably one that would be a good one for you.
Yeah, I don't think so. I saw that they've obviously scrapped that. Yeah, I don't think that there will be any update on that, but I guess I don't really have too many insights as to sort of what they're planning on doing other than taking it away.
Yeah, okay. And I would have thought that if they were going to cut the stage 3 tax cuts, then maybe we would see that come in. But middle income earners will get a reduction in those stage 3 tax cuts, won't they?
Yeah. So anyone earning over 45,000 will benefit from the stage 3 tax cuts. So it will still benefit, you know, a number of Australians.
Yeah. Okay. So Jeff Lowe has asked, what, if any, impact do you see on this budget having on the trajectory of interest rates? So look, I think we're going to get a bunch of answers there, and I'm happy for any of the panel to comment on this. Liam, what's your views on that?
I'm a little bit on the fence. It'll be interesting to see the opposition's response, which is probably underway. But I think in sort of the public domain, they've definitely said they expect there to be an adverse impact on interest rates. But I'm not necessarily convinced, but I'll wait and see.
Yeah, I did note during Treasurer Chalmers' talk, he mentioned not working against the Independent Reserve Bank. So, like you, I'm certainly very much on the fence. But I think if the government doesn't act to stimulate the economy too much, it'll mean that the Reserve Bank is required to have less rate increases. And I think if you look across the spectrum of what economists are saying, is that we can expect to see rates start to come down in 23, 24. So I didn't pick anything in this budget that would work against the Reserve Bank. And I think that's a very good point. That let's see what the opposition says about that. A question that's come through from Sean said, hi Andrew, in relation to temporary full expensing for instant asset write-off finishing on 30 June 2023, how much depreciation can be claimed after that? Liam, that's certainly in your court, not mine.
Yeah, so I guess the temporary full expensing measures, they obviously weren't extended, not particularly surprisingly in the current environment. But I mean, if you've claimed the depreciation, you obviously can't claim it any further. The asset's fully written off, and then you just revert to normal, you know, the standard self-assessment or the published effective lives.
Okay, so if you haven't written it off completely, you'll then look at what your written value is for that year and base it just on the standard rate.
Yeah, if you applied TFE, it's gone. But
yeah,
you know, thereafter just revert to normal.
Yeah. Okay. Excellent. So we still do have some time if there's any more questions that have come through. I think we've run through all the questions that we had. So as we've gone through, and quite often in budgets, the devil is in the detail and determining how it impacts on you. If you would like to get our full report, head over to rsm.com.au and you can download it from there. We'd like to thank you for your time today, and we will end up our webinar there. Thank you on behalf of the RSM budget team, and thank you to our panelists.
Thank you everyone for joining.
Thanks all.
Thanks all. Thank you.